Welcome back. Let's get chatting with the management of Alembic Pharma. What stood out for the company this time around was that there were better gross margins, and as a result of which the company reported a multi-quarter high EBITDA margin this time around as well, largely because of increased offtake in the API segment. The stock currently under pressure, but the outlook for the year is extremely important. We have Pranav Amin, who's the Managing Director of Alembic Pharma, joining in. Thanks a lot, Pranav, for joining in. Let's talk about the year ahead. A lot of the street is pinning its hopes on you making new filings in the US in the next year in terms of ANDAs. And at the same time, your expected margins are likely to improve by almost 100 to 150 basis points. Could you give us a sense of what street should pencil in for the next couple of years on both the top line and the EBITDA?
Sure. Hi, good morning. We had a decent year, a pretty good year and a quarter as well. For the quarter level, the revenue was up 8%, EBITDA was up 29% for the quarter, and the profit was up 17% to 178 crores. So it's been a good performance. Even for the year, it's been very good. For the year, the sales were up 10%, whereas the profit was up 80% to 616 crores. But what is more heartening in that is across the therapies, across all the segments, we've seen quite a bit of decent growth. US, which started off a little slow, has been picking up. Last quarter, US itself grew by about 19%, which is quite heartening, whereas the rest of the world generics grew for the year at about 23%. So in terms of expectation, I think we had a gross margin of upwards of 70%. We'll stick to that kind of number moving forward. What will happen is we have a lot of new facilities, we have a bunch of new facilities that have come up right now, be it either the injectables, the onco, and the new oral solid as well as derm. So as these get more utilized, as we have more approvals from these facilities, you will see a lot better traction in the margins and a lot more efficiency from the facilities, which will help margins moving forward as well. In terms of the US market, we expect to launch about 25 products in the coming year.
Okay, all right. Hi, Pranav. Good morning and good to see you. As you said, in the past quarter, I think the gross margins were mid-70s. You're guiding for around 70% gross margins on. Let's take it piece by piece then. I wanted to understand your US business. As you said, 25 ANDAs is what you're looking at launching. And also, a couple of brokerage reports have said there are some high-value launches that are expected over 25, 26. Now you're doing a run rate of close to around $50 million on a quarterly basis. How do you see this number scale out? On an average, for 25, what will the US business contribute on a quarterly basis? And for 26 as well, gradual scaling up. Give us a number.
Yeah, so we haven't given a guidance per se in terms of the gross margins. We had always said that we'd like to keep margins upwards of 70%, and I think we'll be at that level. As regards to US business, you're right. I think this year we've clocked about 200 million or so. We hope to grow on this in double digits at least moving forward. But it's also a function of two things. One is what kind of price erosion we see in the existing portfolio and how well we do on our new launches, the 25 products that we hope to launch this year. But I expect that to have double-digit growth in the US at least.
And this is accounting for the price erosion of high single to low double digit?
Yeah, I think the price erosion is still there across the board, across all segments, but it's much lower than it was about a year and a half, 2 years back.
Back home in India, a couple of businesses I wanted your thoughts on in particular. One is the animal care business, which did about 350 crores last year. What is it likely to do this year? And the acute therapy business saw a decline of 1.5% in FY24. What is that business likely to do in FY25?
Yeah, so the veterinary business, the animal health business that we have, it's a very well-run business, and that's been growing really well for the last couple of years. So that'll continue growing. I think we've got new product launches. We're focusing on that a lot more. So it's a well-run business and expected to grow. I think it's grown by about 20-30% this year, continue at the same rate moving forward. In terms of the acute segment, I think it's not just us, but there's been a general stickiness around the entire market or the representative market that we are present in. We've done a little better than the market that we're present in, but it's been a little sticky. Compared to that, on the specialty side, our growth in some of the specialties such as gynecology, gastro, ophthalmic has been really good. And that's been almost 20 to 30% growth in a lot of these individual segments.
All right, Pranav, let's leave out the near term. But I'm looking at a couple of sell-side notes. They expected margins to scale up to around 21% by 2027. Is that possible? And they've given 4 broad reasons. One is high value launches. The second one is the 25 new launches in FY25. Also cost optimization and improvement in gross margins. This as a share of API declines. Is that possible? Should that be the goal? In the next 2 to 3 years, the company starts delivering 21% odd margins?
Okay, so I'll come back to the margins, but first thing, I just want to clarify that the API business, we have a very high quality API business, and our API business is a pretty high margin business. So API margins are not dragging our margins down right now. In fact, they're pretty good. But on the other side, as you said, the 4 reasons, yes, I think it is possible, in a couple of years' time, and we hope that to get to that 20% plus kind of EBITDA margins. And I think the way it'll happen is few things. One is we have, as I mentioned, 3 new facilities or 4 new facilities, which are not fully utilized. So there's a whole bunch of cost unabsorbed overheads in that. As we get more launches, you'll get a lot more efficiencies and much higher returns on these facilities. Number 2 is new launches. I think as we launch and the revenue base increases, that will also help. And thirdly, we're doing a lot of cost optimizations as well. We've optimized a lot of our R&D cost. Apart from that, on the operating levels, also this quarter, we had a good efficiencies in our plants and a lot of scale that helped get the cost down. So yeah, I mean, in a couple of years' time, that is our goal.
All right, so 21% margins in a couple of years' time would be your goal. You spoke about a couple of factors. One, you spoke about the R&D spends, and you spoke about your API business itself. Let's get some more clarity on that. R&D, you said that around 550 to 600 crores is what you're going to do this year. So what will it be primarily utilized for? Will it be biosimilars? Will it be directed towards complex generics? Yeah. And on your sales mix itself, what is it likely to be, API versus formulations? Currently is roughly 80-20? 2080 rather?
Yeah, so if you see around about 6,000 odd crores of revenue, 6,200 crores of revenue that we had, API is about 1,100 crores, 1,200 crores. So that's the mix. I think it'll remain the same. All segments will continue growing. If you see the ROW business, that's been growing a little faster over the last couple of years. So I expect that to be closer to about 10-15% growth, whereas API will be 10% at least, US 10% at least. And India, let's see how the market grows, and we'll grow at better than the market. As regards the other bit, I think you were asked about
R&D.
The API business. So our API business is a pretty well-run business, as I said, because it's generally we supply to all the regulated markets, and it's a pretty well-run business across the territories. We focus on from our FDA plans. So that's what our API business is. As regards to R&D, that was your second question. In terms of R&D spend, where it'll be, we don't have any biosimilars and we're not venturing into biosimilars. What we're doing is it's pretty much on the generic side. As we go along, we've optimized a little bit of our portfolio, but now we're doing a little more on the complex injectables, long-acting injectables, some more complex products. So hence some of the R&D spend will go up. We also have some drug discovery, and we have a drug discovery project. So maybe we'll do some seed funding for that as well.
Appreciate you joining in, Pranav, and filling us in with all those details. You have bright prospects for the company with the launches and the cost optimization as well. We wish you well, and we look forward to chatting up with you all through 2025. Thanks a lot for joining in. For the time being, we'll slip into a short break. You come back, we'll continue to focus on markets. We're still holding with a gain of around 100 points, but the Nifty has slipped a little bit from the top. Don't go anywhere.